So who actually executes the trades that these hedge fund makers do at this conference in Florida? And of course, when they're back doing their day jobs, well, we're going to talk to a couple of them. Peter Costa, governor on the New York Stock Exchange floor. Joe Cangemi with ConvergeX now, and a former trader from the floor. Full disclosure, I've known you guys for a long time. We spent a lot of time on the floor together.
Yes, we did.
You have a very unique perspective. Peter, I'm going to start with you. Is there life viability on the trading floor, or is HFT the future?
Well, that's a two-part question, and I'll answer both parts individually. The first part, I do think there's viability of the trading floor. I still think there's a need to have human intervention and have a human part of the switch. If there's going to be a problem, you have to have someone to say that we have to end this problem or correct it very quickly. If you leave it up to a computer model, some of those models don't operate 100% all the time. And if there's a problem, there's got to be somebody there to fix it and to determine when it is a problem. And the second part about high-frequency trading. Now, 2 years ago, I would think that might have been an issue where that high-frequency trading might end the New York Stock Exchange the way we know it. But over the last year and a half or so, I've seen a lot of companies, a lot of those high-frequency shops close down because their margins are so thin. Mm-hmm. I mean, the basic idea and premise between the because of the high-frequency trading is that they are very quick executions, or at least they're part of the process, and they cancel very quickly. They enter orders very quickly,
right.
And they'll get executed periodically. But when they're competing against themselves, there's no room to make money for them. So I think that's one of the problems, is that their margins are narrowing, and the ability to make money in that space is becoming smaller and smaller. So I don't think, in another year or two, are we going to have this conversation? I don't think we're going to have this conversation.
Interesting. Joe, would you agree?
I think high-frequency trading is here to stay. I think that Peter is accurate in making the statement that competitively, their margins have been reduced dramatically. And that impact has shrunken the dollar invested in U.S.-based strategies. I think that the very same groups are expanding into other asset classes and other markets globally. There will be consolidation, like any business in my history.
Yeah.
We've seen consolidation as margins reduce. People, have to get that synergy of the expansion and the ability to put more capital work in more places. So I do think that high frequency trading has a place in our business. I do think that the press, the media, have kind of glorified the name HFT and kind of broadened the definition of it. There is a subset that probably has a very predatory nature to it, and there is a very, very large subset of it that compete very competitively based on the use of intellectual properties and speed of access to the markets to outperform the rest of us laymen, quite frankly.
Has it scared away retail investors? What's happened to the retail market? Why is it so quiet on that trading floor, Peter?
Do you want me to answer that first? Obviously. All right, well, there's a couple reasons. I mean, after going through 2007 and 2008 and seeing their portfolios and their pensions shrink by 60 to 70%, a lot of retail investors are afraid. All right, that being said, high-frequency trading has been part of the problem, but it's not the whole problem. Faith in the equity markets, that's another issue. There's probably about 6 or 7 different issues that have kept the retail investor away. What's happening now, and this is whenever this happens, has happened in the past, the retail investor is slowly moving back into the market. It's usually the top. So they're going to be buying at the top of the market, and then market will probably have to at some point sell off in the next 6 months, and then they'll get burned again, so then they'll move away again. So it seems that the retail investor, because of their reticence to act at the beginning of a bull market and always act at the end of a bull market, always puts them behind the 8 ball, and I think that's had a detrimental effect for the investor overall. When they're late to the game, they don't make much money.
Joe, what would you say about investor confidence? How would you describe that now?
Well, first of all, I do think there was a crisis of confidence on the retail side. I'm not 100% certain that level of impact that we had in 2008 moving into 2009, greatly magnified by the events of May 6, 2010.
Flash crash.
Yeah, the flash crash. I believe that we've gotten to a much better place from then. But I also do see a general sentiment amongst investors in general, and that's retail and institutional, of complacency as to where to put the money to work. We have lots of influences, whether it be Washington, D.C.'s ineffective handling of our financial crisis, the fact that we've had to do financial bailouts of major corporations in our country, and to no one pointing a finger. You know, the banking industry was responsible, the financial industry was responsible, high frequency trading is responsible, Washington, D.C. is responsible. We've had a confluence of events that will make a senior person quite reticent as to gambling a little bit with their money. So they're less risk averse. I think that psychology would say that they're risk averse. They're not as risk averse as they were in 2008. There is money going into the market. We've actually seen a very, very aggressive move between the last 3 weeks of December into the first 3 weeks of January. That generally takes place later in the beginning part of a year, generally more towards tax season. You'll see the investment of bonuses and stuff.
Right.
We saw an acceleration of that. That might be creating some false positives right now. Trying to kind of weed through some of that data. But generally speaking, I think the investment climate is better. I do think that there is a danger because a lot of the same problems that have caused the investor confidence crisis still exist.
One thing that might not exist in current form is the New York Stock Exchange. Now, since Peter, you're still there, Joe, you spent a lot of time there, how quickly the world changes where there is a possibility that there is an acquisition by an upstart exchange.
Well, you know, and Joe will have to say the same thing. I'm a part owner, so whatever I say is, you know, I'm wearing two hats. I'm looking at it as an investor, and as far as an investor, and as far as looking at ICE's past and their history, I don't have a problem with that. I would love to have seen a higher price, but you know, that's just typical American greed. But I don't have a problem with ICE buying the NYSE. I know that, you know, things change. You know, we have to move forward. I think that their business model and the amount of technology that they can bring to the table is way more than the New York Stock Exchange has right now. I think that if they still believe that the model that works on the trading floor for what it is still a viable model and it's not losing money. So if you're looking from the bottom line standpoint, the exchange trading floor is not costing anything, and it's also a great marketing tool. And I think that it's not worth $8.9 billion as a marketing tool, but it's certainly not worth closing. So that, to me, that I still feel very confident that the exchange will exist. It just has a different owner.
And final word from you, Joe.
Well, you know, it's sad, to be honest with you. That's my home. We all kind of grew up there in a sense or in a manner of speaking. It is a little shocking that a 12-year-old institution can take out a 200-year-old institution. And I mean that in the grandest of terms. But times have been changing. And as you noted, Pete's still down there. And I've gravitated off the trading floor. I'm still in the financial industry, and I'm still trading for the very same clients we always traded for. But the marketplaces needed to evolve. There are a variety of reasons for that. I can tell you that it may seem like it happened overnight, but you know, when I first started, they were telling me, kid, you're too smart for this place. It's not going to exist. It's going to be a movie theater. Well, it thrived during most of my career. It has a means of resiliency. I think that is a compliment to the people that are on the trading floor. I do believe that the floor will exist going forward. I do believe it is a viable piece of our market structure as a whole. And I will see it in the relatively near future. Whether it's another 10, 20 years, I don't know. Because time does have a continuum down there that's very different than anywhere else.
Time has changed neither of you, by the way, so I'm glad you guys haven't changed.
Clean living.
Yeah, yeah, right.
Yeah, well,
we got to end it there.
don't tell my scale that. My scale will tell you a different story, but whatever.
Joe, Peter, pleasure to see you guys here in Florida.
Thanks, Rhonda.
Thanks, Rhonda.
I'm Rhonda Schaffler. This is Reuters.